4 days. That's how long it took SpaceX to spend $60 billion after the biggest IPO in history. Not $60 billion in cash. They don't have $60 billion in cash. They have $16 billion in cash and $30 billion in debt, $60 billion in stock, freshly printed SpaceX shares. The same shares retail investors bought at $135 just 96 hours ago. 4 days after raising $75 billion from the public, SpaceX turned around and used that same public equity as currency to buy something. And the market loved it. SPCX jumped 16% on the announcement, hit an all-time high of $225, briefly made SpaceX the fourth most valuable company on Earth. But here's what nobody is stopping to ask. What exactly did SpaceX buy? Is it worth $60 billion? And what does this deal mean for every person who bought SPCX last Friday? That's what we're doing today. The company SpaceX acquired is called AnySphere. You probably know it by the product it makes, Cursor. Cursor is an AI coding assistant. If you're a software developer, you've almost certainly heard of it. You open Cursor instead of a standard code editor, and it uses AI to help you write, debug, and understand code faster. For a while, Cursor was the dominant product in that category. In June 2025, exactly 1 year ago, Cursor held 41% of the AI coding assistant market. That's not a small number, almost half the market, in a category that every major tech company is fighting over. The business scaled fast. By November 2025, Cursor crossed $1 billion in annualized revenue. By the time SpaceX agreed to buy it, that number had grown to roughly $2.6 billion in annualized revenue. On paper, a fast-growing AI software company with $2.6 billion in revenue sounds like a reasonable acquisition target. But here's the number that doesn't make it into most headlines. By May 2026, the month before this deal was announced, Cursor's market share had fallen from 41% to 26%. In 12 months, they lost 15 percentage points of market share. That's not a company at the top of its game. That's a company being squeezed. And SpaceX just paid $60 billion for it. Let's do what we always do on this channel, the actual math. Cursor has approximately $2.6 billion in annualized revenue. SpaceX paid $60 billion for it. That's a 23 times revenue multiple. For context, NVIDIA, the most valuable AI company in the world, trades at roughly 20 times revenue right now. SpaceX just paid more than NVIDIA's revenue multiple for a company with declining market share and no publicly disclosed profit margin. Now here's the part that directly affects you as an SPCX holder. The deal is entirely in stock. No cash changes hands. SpaceX is paying Cursor's founders and investors with SPCX shares, Class A common stock, the same class retail investors hold. To fund this deal at current prices, SpaceX needs to issue roughly 312 million new shares. 312 million new shares added to the float means every existing SPCX share gets diluted. The dilution at IPO valuation is 3.4%. That sounds small, but think about it this way. If you bought $10,000 of SPCX at $135 on Friday, by Tuesday, your stake was mathematically worth 3.4% less, not because the business changed, but because 312 million new shares were created and given to Cursor's shareholders. You didn't vote on this. You weren't asked. SpaceX used your equity as currency 4 days after you bought it. Billionaire Bill Ackman said on X that the dilution is actually a feature, not a bug. The Cursor acquisition costs materially less in dilution because of SpaceX's high valuation. And technically he's right. At $135, this deal would have been much more dilutive. At $200 plus, it's relatively cheap in percentage terms. But the question isn't whether the dilution is large or small. The question is whether $60 billion for a company losing market share is a good use of your equity. And that's a question nobody on Wall Street is asking loudly enough right now. To understand why SpaceX bought Cursor, you need to understand the problem SpaceX is trying to solve. When SpaceX merged with xAI earlier this year, it absorbed Elon Musk's AI lab. On paper, that sounds like a massive upgrade. xAI had Grok, one of the most widely used AI models in the world, and Colossus, one of the largest AI data centers ever built. But here's what the IPO filing quietly disclosed. xAI lost $6.4 billion in 2025, and by the time SpaceX went public, all 11 of Musk's original xAI co-founders had left the company, every single one. Musk himself publicly admitted that xAI was not built right the first time around and that he was rebuilding it from the foundations up. So SpaceX went public carrying an AI division that had burned $6.4 billion, lost its entire founding team, and needed to be rebuilt from scratch. Goldman Sachs projected that division would generate $322 billion in revenue by 2030. We talked about this in our first video. That projection is the majority of the justification for SpaceX's $1.77 trillion IPO valuation. Cursor is the answer to the question, how do you rebuild an AI division fast enough to even begin justifying that number? Cursor brings SpaceX two things. First, an enterprise customer base. Cursor has real paying customers. Companies that use Cursor to write code are now potential customers for SpaceX's Colossus data center compute. The strategy is to own the software layer on top of the hardware. If developers use Cursor and Cursor runs on Colossus, SpaceX captures revenue at both levels of the stack. Second, engineering talent. The fastest way to rebuild an AI team after losing 11 co-founders is to acquire a company full of elite AI engineers. Cursor's team built a product that reached $2.6 billion in revenue. That talent is genuinely valuable, even if the market share is declining. There's also a deeper connection that predates this deal. Two of Cursor's senior engineers, Andrew Milich and Jason Ginsberg, left Cursor to join xAI earlier this year. Cursor was already training its newest models on xAI's Colossus infrastructure. This isn't a bolt-on acquisition, it's a relationship that was already embedded before the ink was dry. Here's where we earn our place on your subscription list. Because the stock went up 16% on Tuesday, and every headline called it a genius move. So let's look at the other side. Risk 1. Declining market share. Cursor went from 41% to 26% market share in 12 months. The company losing ground to it is Claude code, made by Anthropic. Here's the irony. Anthropic is simultaneously one of SpaceX's biggest customers, having signed a $45 billion multi-year deal for AI compute capacity ahead of the IPO. SpaceX is selling data center capacity to the exact company that is eating Cursor's market share. SpaceX is now in a position where one of its most important infrastructure customers is also its most dangerous competitor in the AI software layer. That's a genuinely unusual strategic tension that hasn't been resolved. Risk 2. No disclosed financials on Cursor. SpaceX has not provided investors with details on Cursor's customer list, momentum, or revenue breakdown. We know $2.6 billion in annualized revenue. We don't know the margin. We don't know the churn rate. We don't know how sticky the enterprise customers are or whether the market share decline has accelerated in the last 60 days. You are being asked to accept 3.4% dilution for a company whose financials you haven't seen. Risk 3. The termination fee problem. The merger agreement includes a $10 billion general termination fee payable by SpaceX if the deal falls apart, and a separate $4 billion regulatory termination fee if it's blocked on antitrust grounds. SpaceX's own legal team included that $4 billion regulatory fee because they believe antitrust review is a genuine risk. Microsoft owns GitHub Copilot, Google has Gemini Code, Anthropic has Claude Code. The Department of Justice is watching AI consolidation very carefully right now. If regulators block this deal, SpaceX pays $4 billion and gets nothing. Risk 4. This is what they chose to do first. SpaceX raised $75 billion from the public on Friday. The company has $30 billion in debt. It has a $20 billion bridge loan sitting on its balance sheet tied to AI infrastructure acquisitions. And the first thing management did with its new public equity was not pay down debt, not fund Starship development, not buy back shares. It was a $60 billion all-stock acquisition of a company losing market share. That tells you something about management priorities. Whether you think that's visionary or reckless depends on how much you trust Elon Musk's AI strategy, but it's a signal worth paying attention to. So, is this a good deal or a bad deal? Here's the honest answer. Morningstar, who values SPCX at $63 per share versus today's price above $200, called it more or less value neutral. Their best-case scenario adds $15 to their fair value estimate. That's the bull case from the most skeptical major analyst covering the stock. Bill Ackman called it a smart use of a high-value currency. Paying an inflated stock to acquire real assets is a classic move when your valuation is running hot. The market voted with a 16% gain on Tuesday. But here's what I keep coming back to. The XAI division that SpaceX absorbed lost $6.4 billion last year and lost every single one of its founders. Goldman projected it would generate $322 billion by 2030. That projection is the foundation of the entire SPCX valuation. SpaceX just spent $60 billion of your equity trying to make that projection come true. It might work. The Cursor customer base is real. The talent is real. The Colossus infrastructure is genuinely world-class. But the first move a company makes with fresh public equity reveals its priorities. And SpaceX's first move was a $60 billion bet on a product losing market share in a division that hasn't found its footing to hit a projection that requires 100 times revenue growth in 4 years. That's not a deal breaker. But it's the thing you should be watching between now and the first earnings report. Because that report will tell you whether the AI strategy is working or whether the $322 billion projection is starting to look like what the most skeptical analysts have been saying all along. A number designed to justify a valuation, not predict a business. SpaceX spent $60 billion 4 days after the biggest IPO in history. The market celebrated. The stock hit $225. But your job as an investor isn't to celebrate with the market. Your job is to understand what just happened to your shares, what the risks are that nobody is explaining properly, and what to watch next. The next major signal is Q2 earnings on June 30th. That's 13 days from now. It's also when the first potential lockup release could trigger, and we're covering that in full detail in our next video. This is SPCXLY. Subscribe if you want the analysis, not the headlines. See you for the next one.